Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome back everybody. So let's take a look again on euro currency. As usual, we have prepared the weekly report on euro currency. This time, guys, don't worry, I really do not want to overload you with a lot of information right before the New Year's holidays. So this report I've prepared relatively small, and mostly it is dedicated to a major question right now that stands in the minds of the investors. So everybody is speaking about that the Fed should start cutting rate next year, and it's lots of different suggestions. Somebody tells in the March, others tells in the June. So different degrees of the cutting rate. So market expects 1.6%, while the Fed expects 0.75%, less than the percent decrease in 2024. But we suggest that this is really vital information for the performance of the Forex market. So, and in this report, we have tried to focus right on this subject. So when still the Fed start cutting rate, and in particular why? And we well, trying to answer on this question, not just but some gut feeling, but based on some particular statistics. What could force the Fed to start cutting rate? So that's actually what we talked about in the report. Second subject, we already, well, briefly have touched this topic in previous few weeks, and it stands around the policy in other countries, in particular speaking in the in the European Union and in England, United Kingdom. So, and somehow this, currently the consensus instead that Bank of England and the European Central Bank have to keep rate on the high level for longer compared to the Fed. We totally disagree. We think that, well, maybe only about the United Kingdom that might be true, but speaking in the European Central Bank, at least we're trading mostly euro to United States dollar, we have really big doubts that this will happen, mostly based on the statistics that we have. This is first moment. Second moment is just, if you'll take a look at the anticipation and the forecasts on the degree of the rate cut from the Fed and from the European Central Bank, you will see that market approximately expect the same level of the rate cut. So which stands around 1.5, 1.6%. As for the United States, as for the European Union, it means that since rates are lower in the European Union, it means that if cut will be approximately at the same level, United States dollar should not lose its attractiveness from this point of view, from this factor. So, and taking it all together, it seems that the factors that are mentioned as a probable drivers for the United States dollar drop in the next year, well, they might be not as obvious as it's suggested. So we're not sure that particularly these factors will become the major drivers of the dollar weakness. So if you're interested in all this stuff, you could read the report and make your own conclusion also on the subjects based on the numbers, charts that we have prepared. So I think it's interesting and, well, educative for in the current situation. Returning back to the technical side, it is not really very new. So actually, if you take a look at the weekly and monthly chart, you will see nothing actually. It's mostly the same. Actually, I would say that even the monthly chart looks right now looks in the same as it was in the beginning of December. The only update that we could prepare mostly dedicated to the daily and intraday charts, and here we do not have big changes compared to Friday as well. So here you can see that still we've got reaction on the COP target and the butterfly extension. And our major suggestion is that, well, we hope that the sentiment on the market hardly will change drastically through the New Year's holidays, and it should stand valid in the January, maybe in the February as well, because we also see some headwinds for the dollar in the February, because you know that Joe Biden has signed only the temporal financing for the government, and it will be once again another showdown in the government concerning the financing. in the budget right in the beginning of the year. Besides, United States will be very, very busy with the Taiwan elections that will happen on the 13th of the January. It's first hot geopolitical topic that will come in place. On all this really mess, theoretically, investors should keep their view that the euro somehow should be more attractive, at least in the beginning of the year. So that's why we think that from that standpoint, context should stay. And that led us to suggest the strategy that, well, mostly stand around the possible deep to buy on the euro currency for a possible upward continuation. Because even technically, if we'll take a look at all time frames, daily, weekly, and monthly, everywhere, context stands bullish, trend is bullish. We have the acceleration here. So next upside target remains the same. It's 112 approximately. And next one is 112.90, which is major OP of this ABCD pattern. That's what we intend to keep an eye on the nearest, well, few weeks probably. But right now, in the next week, we will be focused on this pullback. So on the fall time frame chart, market is challenging the first level that we have specified, it's 1040, and it comes to the next one. And this level actually, well, fits very well to our purposes. First of all, it is near the neckline of the hand and shoulders. It is near the previous tops on the daily chart, and it is relatively strong because this is confidence. So that's why we consider this level as a primary one for possible long entry on the next weeks, 109.80. Speaking about downside ABCD pattern that we discussed on Friday, take a look what has happened here yesterday. It's a really big fight right around this level, and this is good bullish sign. So it means that investors, as we said, also consider levels for a long entry, because you take a look, few pullbacks have happened while once market were testing this level. It was relatively safe to take the position, and you can see it's first pullback, second pullback, third pullback. So lots of time and opportunities to move stops to the break even if you have taken position here. But it seems that currently it is breaking down, and we still will have to deal with the 110 level, which is the XOP, and take a look at great agreement with the confidence support on the fall time frame chart. So that's why, shortly speaking, our next scenario is actually next step in our trading plan. Just watch for this level and consider chances for taking the long position, because if euro currency indeed stands bullish and keep bullish sentiment, with a high probability it should hold above this area. So theoretically, this level has all chance to reverse action to the upside once again, if nothing will change in sentiment. So at least by the technical rules, and as usually it happens, this level is strong enough to keep any bullish market. So that's our 2 cents on euro currency. Take a rest, enjoy the holidays, spend with your close ones, and see you already in the next year. See what will happen on the next week. By the way, there's 2 major events. It's payrolls, as you know. So we put the forecast from the raters concerning the payrolls in our Telegram channel, and it will be a release of the inflation statistics in the European Union. It also will be interesting.